meeting to order. Selma City Council special meeting, March 28, 2019, 9:00 a.m. even. Call the roll, please.
Councilmember Avalos?
Here.
Councilmember Guerra?
Here.
Councilmember Trujillo?
Here.
Mayor Pro Tem Franco?
Here.
Mayor Robertson?
Here. Okay, potential conflicts of interest. Any council member has a potential conflict of interest may announce the item now and recuse themselves from discussing or voting on the matter. Okay, with that, we'll move on to oral communications during public comments. If you wish to address the City Council under Government Code 54954.3a, you may only address the City Council concerning any item that has been described in the notice for the special meeting. Members of the public shall limit their remarks to 3 minutes. Are there any oral communications this morning? That will move on to regular business, presentation and discussion regarding the fiscal year 2017-18 financial statements with independent auditors report. Report, please.
Thank you, Council Mayor. Today we have our financial report. As you're aware, we are required on an annual basis to have an independent auditor come in and do a financial review. Today with us we have for the presentation is Bill Patterson. He is one of the partners of Sampson & Patterson, who has been doing the audit for the last couple of years now. So at this point, I'd like to turn it over to him, and he can give you a formal presentation.
Okay, thank you very much. Good morning, Mayor and council members. Hopefully you all have a copy of the report in front of you. I'll go through it, kind of give you an overview. If you want to stop me anytime as I'm going through it, please feel free to do that. A couple pages in is our independent auditors report. It's right after the table of contents. And this is where we give our opinion on your financial statements. The opinion paragraph is about 4 paragraphs down. We gave what is referred to as an unmodified opinion.
What page is this, Bill?
It's right after the table of contents. The independent auditors report, although it's page 1, it's not numbered.
It's like page 20 of our packet. Is that the one?
Have you opened up this number?
Okay. I'm looking at mine from the meeting.
The very first page, the title page.
Okay. I'm looking at mine from the last meeting.
It's the same one, they just put it on front.
They just repaginated. Okay. Got it.
Looks like
One with the letterhead on it.
no, that I don't think that's.
This one. Yeah, it starts with significant audit matters.
Oh, no, okay, it has it's past that.
Oh. Which?
Past the table of contents, and to, document that independent auditors report.
Got it.
Yeah.
Found it. Thank you.
That first report was a report to those charged with governance, is what it's called. I'm not going to go through that. There's really nothing significant that's in there. You can take a look at that at your leisure. Everybody at the independent auditors report then, right after the table of contents.
Mm-hmm.
About the 4th paragraph down is the opinion paragraph. This is where we give the opinion on the financial statements. Again, we gave an unmodified opinion, which means that basically that we believe that the financial statements are fairly stated in accordance with generally accepted accounting principles. So that's the kind of audit report you want to get from your independent auditor. Right below that, I wanted to draw your attention to a change in an accounting principle during the 17-18 year. For the 17-18 year statement, GASB statement number 75 was adopted. And basically what that is, that's putting your other post-employment benefit liabilities on the balance sheet. Previous to this statement, the way it worked was your actuary would give you what was called an annual required contribution. You have to pay in so much, like for example, say $500,000 is what your actuary said you needed to pay in for OPEB. If you paid in,
Just so we're clear, OPEB is other post-employment benefits.
right? Okay. So if you paid in your $500,000, then the liability would be 0. There would be nothing showing on the balance sheet as a liability because you paid everything in that the actuary said you needed to pay in. What GASB 75 said was, well, no, that's not good enough. What you need to do now is you need to put your entire liability for OPEB benefits, do an actuarial study, figure out what that number is, and put that on your balance sheet, not just the number that you should have paid in for that particular year.
I'm sorry, can you identify total liabilities?
Total liabilities,
For the city, right?
for the OPEB portion?
So there's different parts that are reported here. One's the pension and one's the OPEB. So
Okay.
just to clarify which,
Okay,
he's suggesting the accounting changes that are affecting the financial statements.
okay.
So we can get into that part if you like.
Yeah,
but-
we'll get into the specifics in just a moment. I just wanted to make you aware that for the 17-18 year, there was a new pronouncement, and as a result of that, you had to put the OPEB liability on your books for the first time.
What
You've
would
never
be an
had to do that
example of,
before.
Phil, OPEB as opposed to like CalPERS? What would an example be?
Well, would be like health insurance benefits that you provide to
So say you
retired
would
employees.
Retirees.
provide health insurance to an employee
Right.
that
So it's
retires,
embedded,
that would appear under OPEB as opposed to pension liability,
Right.
CalPERS.
Mhm.
But Rule 75 says you gotta include all that in your financial statement for the city,
Yes,
correct.
because
exactly,
you have to pay both out.
right. Uh-huh.
I have a question. So in the 96 accounts that you reviewed in our budget, is OPEB have an earmark account that we're gonna we create per year and we just put it in there, or is it an actual liability?
Yeah, it is a liability
But-
that's determined by the actuary. I think it's every couple of years you have an actuarial
2
study.
years.
Every 2 years. So it'll change every time you have an actuarial report, but that is required to go on your, what's called a statement of net position, and we'll take a look at that in just a couple of minutes. Okay.
It's right here.
So the next section of the financial statements, which begins on page 3 and goes through page 9, is called the management's discussion and analysis. And this is an overview of the financial statements from management's position. So it was prepared by Isaac and reviewed. And so the city manager and the finance department all had a part in generating this portion of the financial statement. Now, I wanted to go over quickly to page 5. Actually, it says page 6. This is going to be changed on the final report. There are 2 page 6s.
What's the heading?
It's on page over.
It's, and I'm looking at the section that says government-wide financial analysis, and there's a table down below it. It says City of Selma's net position. Is everybody with me?
Got it.
Okay. Now, what this table does is it presents the city's financial net position in 3 different categories. There's the governmental activities, the business type activities, and then there's a total of the 2. The business type activities are represented by the enterprise funds, which are your ambulance fund, the garbage fund, Pioneer Village, and cultural arts funds. Everything else is considered governmental activities, with the exception of the successor agency. That is not included in this table. There's a separate statement for that, but it's not included in this table. Okay, so if we take a look at this table, you can see about 3 lines down, total assets. Now, just to back up for a moment, these statements are presented on what is called the full accrual basis. So the revenues are reported when earned, and the expenses are recorded when a liability has been incurred. Now, there are some statements that we'll look at in just a moment that are on a different basis of accounting, and I'll go through that when we get to that point. But this table, everything is presented on the full accrual basis, just like a regular for-profit business.
Business type
Okay.
activities, again, Phil, are Pioneer Village. What are the other ones?
Pioneer Village, cultural arts, ambulance, and garbage. Those
All
are
of, all of our enterprise funds.
those are your four enterprise funds.
Enterprise funds. Not all of them, but just the major ones. Is that right?
That's all of them.
That's all of them. In this part, it's
Those
all
are
of
all
them.
the enterprise funds for the city.
Consolidated, correct.
Thanks.
Okay, so if we look at the total assets, one thing nice about this table and why I'm focusing on
2.6
this
extra.
part of it, this is the only place in the financial statements where you'll see these numbers on a comparative basis. Since these financial statements just for the June 30, 18 year, everything else, all the other statements are just as of and for the year ending June 30, 2018. This kind of lets you look at where were we during the 2018 year and how did that compare to the prior year. So that's why I like to focus on this statement. If we look at the total assets and we go to the total column, you can see that your total assets increased a little over $11 million. Last year the figure was 71 million. This year it's 82 million. Now the majority of that increase is attributable to an increase in cash. And the reason why the cash balance went up so much, you had the general obligation debt, $4 million, which provided cash for the police station. You had some transfers. You had a transfer from the enterprise fund to the governmental funds. So that provided about $1 million more in cash in the governmental activities. And as far as the increase in cash for the business type activities, it was about almost a $2.5 million increase. And that is pretty much all attributable to the ambulance fund. And the reason why that was so much, such an increase from the prior year is during the 17-18 year, you had two payments from IGT, two IGT payments from Anthem Blue Cross.
So if you look at the enterprise, 2017 and 18, just by way of reference, 2017 means 16-17 fiscal year.
Correct.
Fiscal year 18 means 17-18, right?
That's
Yeah.
correct.
And then if you look at that, current and other assets, business type activities from the enterprise funds, 16-17 is 2.3 million, 2018 is 4.8 million. Is that the increase in the IGT payments from the ambulance fund? Or the
Yeah,
that went
that's
into
pretty much all of that increase
So that's
is
about
due to that.
2.5, 2.6 million additional as a result of the two instead of one intergovernmental transfers into the
About
ambulance.
2.4 million of that 2.6 increase is because of that. There was also some increase in receivables and other assets that made up the total. Now, keep in mind, this is what the numbers looked at as of June 30th of 2018. So we're looking at it just on that day. These are what the balances were. Okay. Now, right below that, we have deferred outflows related to pensions, deferred outflows related to OPEB, and deferred loss on bond refunding. All these deferred outflows and deferred losses, they are similar to assets, but they're not considered assets under the accounting standard. Basically, the definition is these come about due to a consumption of net assets that are applicable to a future period. So they're similar to prepaid expenses. So you see in the governmental activities, we had about $3.8 million of deferred outflows. We can look at the details of exactly what those are when we get to the notes. Primarily, well, let me just tell you real quick what they are. A lot of them have to do with changes in assumptions. The discount rate, the assumption of the discount rate changed during the year from 7.6 to 7.1. So that created a deferred outflow.
That's CalPERS, right? That's how much they expect to make on their investments or base.
Yes,
And it's, and the lower the expected return CalPERS, the more that the city has to pay.
Correct.
right.
So
And
the
the
lower the
higher
number
the-
is what
the
is
liability.
the least amount. So if they have a 6, we're expecting to gain that marker. So the higher the marker is the higher return.
So that 0.1% led to about a $425,000 increase in liability for the city. 3.8
Roughly,
from 3.3 to
roughly,
3.8.
but there's some other things that go into that number also. I don't want to get too deep into the weeds, but there's also, you have to look at the payments that were made during the 17-18 year for the pension portion. Actually, the liability is determined as of June 30th of 2017, and it's projected forward to June 30th of 2018. So any payments that are made during the 17-18 year are considered deferred outflows. So that number includes the payments that were made for the pension liabilities as of,
So this
for
includes
the
the actual
17,
money that
18
was
year.
paid for pensions.
That's included in that number also. And then it will be expensed in the 18-19 year.
Mm-hmm.
Okay. But then whatever you paid in the 18-19 year will become a deferred outflow until the 19-20 year.
The next year.
So, yeah. And the reason for that is because the measurement date is June 30th of 2017, then it's projected forward to June 30th of 18. So you wouldn't want to offset the liabilities that were determined as of June 30th of 17 by payments that were made after that date.
You wouldn't want to
Okay.
lower those by the payments that are
Right,
made, lowering
right.
your liability, because you're just going to have new liabilities for the next year.
Exactly. So that's why it's included as a deferred outflow
So really,
rather
the
than
only
reducing
reason this
the
little
liability.
needle should move is if CalPERS changes the interest rate. Then is that right? The discount rate.
Yeah, that's the primary reason. There are also some other changes in
Or you get more
assumptions. Yeah.
I mean, also increase in staffing increases the amount of that we pay into it as well, so that'll affect the number as well. So
Increases the liability
increases
there.
and decreases of the same.
The new system, the PEPRA, how is that affecting the liabilities of the city? Is it kicked in yet? Is it really, everyone's on PEPRA
It is
now, right?
helping.
Since
I mean, a
12
large
years.
majority of our staff are still on the Classic. So as those retirees or those individuals start to retire, you'll see the PEPRA come in, and that's how you'll see the overflow and how they affect
Can you
each other.
just give a brief overview of the difference between PEPRA and the classic pension?
Sure. The Classic employees, their percentage compared to what it is and how we pay in, they're at a marker of like 11% than employees. I don't have the number in front of me. I can look it up. But whereas your PEPRA employees are more like 5 to 6. So I mean, you can see that number is basically almost in half. And so the assumption is you're paying that lower rate structure and paying less into it, but the assumption is they're actually going to be working longer. So the issue that the employees for Classic is the assumptions that were made earlier is these employees would actually retire earlier while you're paying a higher rate structure. Well, that didn't come to fruition. Therefore, you're paying these higher rate structures for employees that are actually retiring later. Is how you have that higher number.
If someone works at Selma and they move to, say, Reedley, does the pension follow them over, or does the pension liability stay with Selma?
It actually gets blended between the two. It also depends on whether they're out of a municipality or the pension fund. If you're out of the pension fund, for example, if you're a Classic and you leave today, but you go to some independent individual and then you come back to municipality or you come back to that pension. If you're out for more than 6 months, then you actually become a peppermint member at that point in time. So those all differ. But it also it can reverse too. If we're bringing on a Classic member to us, that's going to affect us as well as them too as well. So there's some ramifications on how that works.
So with the numbers, what really affects this is the numbers of retirees on the Classic plan. That will affect it and push it up more than new hires, because any new hires, unless they were already on a Classic plan, would be on the PEPRA plan.
That's
which
correct,
has a
and
less,
that's the
a
basic
lower benefit
assumption
amount.
of PEPRA. That once these individuals actually retire, that liability for the current employees reduces and it starts to filter off.
Because that's a really big number. That's a
Correct.
big liability. And is that trending up? I mean, we have a comparative 2 years, but if we would have seen this something like 5 years ago, would it have been less or more with that Classic plan? Just speculation. Phil, you've been on this
Yeah,
a while.
I think the liabilities have gone up year
Have
by
they?
year.
Yeah.
They tend to go up every
There's
year.
more people
a little bit.
retiring.
Yeah. And a lot of it has to do with the investment return. You know, CalPERS is anticipating getting 7.5% roughly on investments, and when that doesn't happen, then the liability goes up.
Which
Is this
creates the
gonna-
unfunded liability.
Is this going to go up for 18, 19 because the discount rate went down to 7%?
That's correct.
Yeah.
The cost that we were paying into the pension itself will increase. So again, as that number continues to go down, The cities themselves are required to pay in more.
And that doesn't include the unfunded accrued liability.
Correct. So your unfunded liabilities are different. What they are is your loss and gains of the assumption.
That's a different factor, and we'll see that in a financial statement in the back here, the unfunded part. Is that right? I thought I saw that.
It's in the notes, yes.
Well, this is the net pension liability. So that is the total liability.
It's a
That-
consolidation.
So it does
yeah,
include the
yeah,
unfunded
That includes
liabilities.
everything, yeah, that includes everything, right. Okay, so the next section is the liability section. And you can see, your assets went up 11 million, your liabilities went up almost 13 million. A couple reasons for that. If you look at the long-term liabilities outstanding, that's about $4 million higher than the prior year, and that is attributable to the new debt, the general obligation debt that was issued during the year, about $4 million. The net pension liability went up almost $2 million. OPEB, that's brand new this year. That's $5,244,000. And then you had other liabilities that also went up quite a bit. A couple things included in that. There's some Measure C payables that were almost $600,000 more than they were the prior year. There was a ongoing project where some bills hadn't been paid yet.
That'd be Floral Avenue project.
That wasn't reimbursed by SB1? That wasn't?
Floral Avenue?
Yeah.
No, the project that we're looking for, SB1, is actually the Nebraska project.
Okay. So the Floral was pre-SB1. Nebraska will be
Correct.
when we
Yeah, the
get
funding
first
source
use of
for
finance.
that project, Floral Avenue, was always Measure C, and then a small balance from LTF, a local transportation funds. And as you remember, that project was about 1.4.
Is that fully, was that fully accounted for, the whole 1.4 in this in 17-18, or will some of it be 18-19 because the project was completed?
We're still
last
making
year?
our final payments now. I think we're about to wrap it all up.
So we'll see a little more. in
Yeah, the
terms
last
of-
component itself was the street light, as you know. It just recently went on.
Mhm.
So that was the last one of the components to kind of wrap it all up. So
Okay, so I've gone over the primary reasons for that increase in liabilities. Just for a point of reference on that OPEB liability, which as of June 30th of 2018 was $5,244,000. Although it wasn't required to be booked in the 17 year, that figure last year was 4.6 million. So your other post-employment benefits liability went up about 600,000 roughly from the prior year. Down below that is the deferred inflows related to pensions. That's similar to the deferred outflows, only go in the opposite direction. Those will be adjusted into revenue in the following year. And then down below,
So that's the employee portion of the pension? That's the employee-funded portion of the pension? What is that?
well, that has to do with the same type of items that are included up in the deferred outflows,
Mhm.
changes in assumptions, that kind of thing, investment, changes in investment over what was originally anticipated. Things like that. So, but these are going the opposite direction.
This
So
would,
you don't net them, you show them separate. So these will be, whereas the other expenses will be, or the other outflows will be added to expenses in the
Mhm.
following year, these will be going into income in future years.
And
Okay.
what's the source of these again? Just interest, investment income?
Generally, those are due to changes in assumptions and an excess of investment earnings over what was originally anticipated. So it may take, those go into income over a number of years. They don't go in the following year. It's like 3 or 4 years that those are taken into income. So you can have a year where you have more investment income than what was originally anticipated. That's not going to go into income immediately. It's done
And this
over a number
investment
of
income
years.
the source is through CalPERS, through the
Correct.
investment? So
That'd
they
be
made
correct.
more money in some of their investments.
Or
than-
in some
than
years, in some years they're going to have more than what was anticipated. In some years they're going to have less.
And it carries
it-
forward to
Yes, it carries
from year
forward.
to year.
Yeah.
Mhm.
But it's not like this is income to the city. This
No.
isn't money that goes in the general fund.
Again, these measured changes are really to get them on the books. So those numbers are on the financial statements and they're visible for everybody to see, is really what this change is creating.
So
Because
this
we're
is to
already
make
doing these
pension
items, the inflows and
liabilities
outflows.
transparent.
That's correct.
'Cause pensions are a big item these days.
Correct. So they started with the pension, the accounting changed for that, and now they tiered into the OPEB. So,
Isaac, this is the, on the other page 6, the second paragraph. So all these is the 11.6 million negative.
You mean the total at the bottom?
correct.
11.6.
So a large factor of that 11.6 million is going to be
All these
your outstanding liabilities for the pension. It's the changes in the assumptions and how they're booked. So if you look at the numbers for the liabilities for the pension, 14 million, 5 million, the big change would be the 5.2 for the government activities. They're all factoring into that number.
If you want to look real quickly, flip over to page 47 to answer the question about the inflows and outflows. You can see how that net amount is going to affect your financial statements over the following 4 years. So it's not all taken into account in the following year. It's spread out over 4 years. But of course, those numbers change from year to year too. So this is pretty much an estimate.
Did any of this affect the city's credit rating? Any of the new OPEB requirements, reporting requirements? Did it have an impact?
I'm not aware of any impact it would have had.
On rating?
This accounting change that everybody's having transpired, so they're
Right.
all putting it on their financials. When you're coming to your bond ratings and things of that nature, what they're really looking for is cash flows, good fiscal policy is your reserves, and how much you have within the reserve policies and how much cash you have on hand that you can readily available
Did
for
the
you.
city's bond rating change for this year?
No. I mean, you're not going to go into a bond rating and get that number unless you're actually issuing some debt structure.
You won't
So
even
we're
know
still
what the
solid
bond
on
rating
the
is unless you
A1.
go get a bond.
Yeah.
Is that right?
Yeah, you don't do a full rating structure like that unless you're going out for some kind of debt structure.
So the last three line items on this statement are a breakdown of the net position or the equity for the city as of June 30th of 2018. First one being your investment in capital assets. Then you have funds that are restricted for various purposes that can't be used for general purposes. For example, street funds. You can only use street funds for street projects. And when it says restricted, it doesn't mean restricted by the city council. It's being restricted by an external source. For example, your bond proceeds cannot be used for operating activities of the city. They have to be used to build the police station, so that's why they're restricted.
Do we know when those additional IGC payments came in? When they actually hit the bank account?
The second one was in June, late June. I don't remember the first one. I did not bring that
18?
information.
2018?
Yeah, that's 18 year.
And the first one was
It
Like
was
before that.
towards the middle of the year sometime, yeah. I'm sorry, I didn't bring that information with me, but yeah, I remember the second one hitting
so
towards
like
late
January
June.
18.
Yeah, I can report that out later today if you'd like, those actual dates.
Okay, so your total net position overall went down $1.3 million. And overall, the unrestricted went up about $1.7 million roughly. So basically what that means, if you were to liquidate, there wouldn't be enough cash available as of June 30th of 18 to pay the liabilities. Those are going to have to be paid from future revenues. That's why there's a negative unrestricted balance. Okay, if we move over to page 7, same type of format, but this is for the revenues and expenses.
This one. Oh, just to cap off, just to finish up the previous one, the 11,604 unrestricted, 11,604,796. That's
Correct.
again mostly the pension liabilities.
Well, the pension liability is about 15 million. You can't just isolate it into one. This is the reason. There are several reasons. You know, you issued more debt. You've got the pension liabilities, the OPEB liabilities. These are all liabilities that are going to have to be paid somewhere down the line with additional revenues. You don't have available assets on hand right now to be able to pay those liabilities. So you can't isolate it. It's just because of this. It's all of them together. There aren't enough assets to pay those as of June 30th of 18.
So when we went to that trade show, Isaac and Heather and I, the actuary said there's like a $37 million pension liability total, or that's the amount in the pensions, and then 30 was funded so far and 7's unfunded.
So they base it off a percentage. I don't remember the total numbers, but there are some of the plans that are funded like 74%, things of that nature. So that's where you kind of gauge on how healthy you are within your pension system. For example, a healthy pension system will be fully funded at 100%. So the lower that number is, it means the less that you can actually pay that obligation off. So at the point of measurement, if it was 47%, it means we pay 47% of our outstanding obligations, and we could pay that off.
So if it's 74% funded, that means the city's has accounted for 74% of that, has paid off 74, but that still leaves 26%. And is the state, I think that's compliant, right? I mean, what's a problem?
Well, in the eyes of the pension, you're not in a major risk factor. Somebody in a major risk factor would be in the high 60s or lower. So you're kind of just at that border mark, which are 74.
So I think the city, we kind of made out fortuitously this year with that sales tax sharing agreement going away with the car dealership in Selma for like $400,000. Is that something that's going to be budgeted every year for pension, to pay into the pension liabilities, or is that something that's going to be just put in the general fund and reserved elsewhere?
That's definitely a conversation we'll have during the budget process on how we'd like to address that, what those revenue streams are. You do have to weigh your current expenditures in the budget, increase in pension costs and things of that nature, but we do want to have a conversation on what that looks like.
Could that number be more than 400,000 for
Well,
the coming year?
As far as
To fund the pension liability, the discount rate is decreasing, so the city has to pay in more. Could that number be more than 400,000 for this coming budget?
Could we factor more towards the pension?
Right.
We definitely could, but again,
And that would increase the percentage from 74% potentially to 76, 77.
well, what it does
Move the
is you
needle.
actually apply it to your unfunded liability, and it reduces that dollar amount, so the money that you're having to pay in future years will decrease.
Which would be beneficial in terms
Correct.
of.
So the more you pay in, the understanding is your payments would be reduced.
And that was one of the plans that we heard about. There are like 3 alternatives that are floating around now, and one of those is to prepay your pension liabilities. But with also the caveat that we don't prepay to CalPERS, right? Because if you send that money and you fund it and they change their system, you're done. That money goes away. If you still have to pay more. You still have to pay that percentage they give you every year, right? Even if you prepay. So I recall a little bit that they said that you need to reserve like an account for that and have a separate account in the city. Is that reflected here? Are we doing that yet?
We have not. Again, that's going to be another conversation we have within the budget conversation, because there are some options that we'd like to talk about our pension, because there is some factors that are going to be affecting our overall budget for the next coming years. Unfunded liability is one of them, and it is increasing at a large rate, at least
It
a couple
is.
100,000 each year.
That number's going up no matter what. People
That's
are
correct.
retiring, and that pension liability is going to go up. We got to think about that.
So there's 2 factors we'd like to weigh, and one of them we talked about was just the trust, putting that money aside and obligating it just for your pension fund.
I have a
Now,
question.
I understand
go
that
ahead.
if we go directly and pay the UAL down directly, we are those saving interest. We are not paying interest to CalPERS by paying down what we owe. So that's a considerable saving that we would have to balance with the concept of the trust to see what the final numbers would be.
There were some cities that were there that actually paid off their pension liabilities, and it didn't benefit them, though. I think they were talking about it was even more advantageous to have that trust, to put that money off to the side, just given the changes. What was the reason it didn't benefit them?
Their assumptions would change, and they still end up some money that they'd have to owe. So it'd factor in that sense.
The pension
So there were some
liabilities
people that
changed.
actually, so there's different things that you can do. You can take some of your unrestricted funds and apply it to help address that number. Some people are actually going out for pension bonds. It's largely discarded right now for you not to do that, because of that risk factor that you have, that you're still going to have an outstanding obligation even if you pay it off. Because the assumption just continue to change.
And you
If they
still have
continue
to
to take
keep
a loss, you
paying
still,
CalPERS every year, no matter what. I
that's
think
not
that
going to
was their
change. That's
thing.
correct.
That's not going to change.
So the common practices
Stuck.
now
You'd have
are
to keep paying, even if you pay down to zero.
So I have a question. I didn't want to entertain this discussion because I wanted you to give us a presentation. But since you guys already dived into what I've been concerned about, so the last conference I went to, they were telling us we needed to have a healthy, structured policy in the finances, meaning in regards to earmarking money and what have you. So since you guys have opened it up, are we going to go through that process on our budget plan and talk about that? Because I heard you say you want to have those kind of discussions.
I do.
Okay, so that's one.
sorry.
The other one is, if we are going to have that kind of discussion, does that mean that we haven't had it in the past?
We have. When we had it was, sorry.
Go ahead.
So when we did have them with the council, it was when we actually started talking about this tax share agreement and it going away. Because it was a large dollar amount that had been earmarked in prior years of $400,000. So that at this time it was going to relieve that money, and we started having the conversation of addressing our pension obligations that we have and allowing that money to go into either a trust or paying her down and setting those structures. Because what you really need to do when you do at that point is set a policy. For example, a good policy would be anything over your reserve of 25% goes directly into your trust. So you set these rubrics on how you set this money aside, and it gives you good fiscal policy to move forward.
Okay, so that's that one. But in regards to all other financial accounts we have, do we have the same kind of policies to have a healthy budgetary structure?
So we do have it for our debt structure policy. We have it for our general fund policy. The next ones that I want to look at are our reserve policies for our internal services and our enterprise funds. Those would be our next conversation in setting up those structures.
Okay.
So those are the ones for
Those are the ones
policies
we're
that I
talking
see us looking at in the future here.
Okay, and one last one. I see on the business type activities in 2017 and 18, on the ambulance fund, we had 1.62 million in 2017. And then in 2018, we had a little over, 1.2.
Where's this? Where are you looking?
On the page 7. So does that mean that we actually moved it over there, or does that mean that that's what actually came in? That's what came into the account.
Where's looking?
I think you're looking at the expenses for the
The
ambulance,
expenses,
aren't
yeah.
you?
That's
Yeah,
what we paid out.
That's what you paid out. It's really not significant difference from the prior year. It's only about 70,000 or so. So you would expect, a
So
few
what I-
percentage points increase every year in what you pay out for ambulance.
So taking that into account and understanding what you told us the last time, so does that mean that if we pay out $1,230,000, we'll be getting probably 8% back more the following year?
Just for the IGT payment itself for that structure, yes.
Okay, it's good to know.
And that's a one-time payment.
Well,
One-time
it is a
expense.
one-time payment each year. Again, they did have, what they did was make an assumption in that fiscal year for a payment for 17-18, I believe, or 16-17. And so they made an early payment. So now they're actually coming back and saying, okay, we made an assumption for that fiscal year. We're going to go ahead and true it up and make sure that numbers all tie out. So they're actually going through that reconciliation.
That's the
process.
problem, when we get reconciled. We get all this money and then, it's great, then we spend it, and then they come back and go, whoa, hold on. Now you're gonna have to pay the piper.
Well,
You
actually, when
didn't
it
have
comes
that
to
many
this
visits."
program itself, sorry to cut you off, they're actually saying there isn't going to be no fiscal impact, there only a benefit to us. For
It always
example, if
benefits us.
we've overpaid, then they'll give us a credit back to our next payment. If we underpaid, they're going to just leave it be. So
So-
that's the understanding they're having right now.
Okay, so I want to make sure I clarify this, because I did a little research since you brought that up, and I went back and talked to the county and found out where we're at. So it actually benefits us if we actually look into the ambulance fund and we actually set some kind of policies to make sure that our numbers are solid, so when we submit them, they are good and we actually get our percentages back, isn't it?
Well, the numbers are based off what it's generating via Medi-Cal. So those are the numbers that actually generate that reimbursement. So it's
And our just to let you guys know, our numbers have been increasing in the last 2 years.
For Medi-Cal, yes.
Yes, they have. And so, okay, so then we don't, and I apologize that we're going into a totally different, but
Yeah,
this
that's
is,
fine.
I didn't want to talk about this, but I want to make sure I have it in my head. So because they've increased in the last couple of years, so it's okay that we don't have some kind of structured, healthy policy, structured plans to make sure that our accounting in is okay? They're already doing it?
Yeah, it's
Is
not an
that what-
accounting assumption that they're using.
It's-
They're not digging into your financials and saying, okay, you have.
No, I know what they're doing because I called the lady and she actually explained to give me in detail of what the way the program works. So I'm just wondering and wanting to know clarification from you, Isaac,
Mhm.
that we don't have to do anything else because they're just shooting you the report telling you, this is what we have and this is what we're getting
That's
back.
correct.
Okay, good. So then we have nowhere we can do. You answered my question. That's good.
So there's no bill that's gonna be coming later on
That's correct.
asking
There
for
isn't.
additional money
The number
back?
is the number is. They're actually generating the numbers and doing the analysis, and then that's the number that they generate on them.
It's a, actually, it's a really good program and there's a lot of money we
Yeah.
lost, but it's okay. We're gathering it and
And again, the program itself is really to make up for the difference with what it costs to actually run the ambulance fund for those chips that are generated by Medi-Cal. Because
we've been
again, we're getting
putting-
reimbursed on
from what
average
I've seen,
$250.
about 1.1 million aside every year has been going into the general fund. And this year, it's 1.5 million more.
So we've always been doing a transfer from the ambulance fund into the general fund. You just seen it starting to get larger because of the IGT payments. So we weren't always getting large amounts, like a net difference of $1 million or so. So the first payment we got was a net difference of 300 and something. So as the program has generated and moved forward, it's modified and changed and things of that nature. So the payments have increased.
What is
So-
the city's financial policy on the enterprise accounts right now? To keep them at zero or to keep money in? Because from what I understand, enterprise funds they shouldn't make money, they shouldn't lose money. Is there a financial policy to clear them out and take the excess money from those enterprise accounts and put them into the general fund every year, or to just let them build up? And I think that's what Councilman Trujillo's talking about in
Correct.
terms of financial
well, I
policy.
didn't want to go there, but now that you're asking, well, my real question was, real quick, what popped me to ask the question was you were asking at the very beginning what policies we have, and in reality, last city council meeting, I was really happy that we're having a really good dialogue in regards to the police department because it actually is us talking to you and setting the policy in order for you to feel a little stronger, correct?
That's correct.
So now, I think we as a council should start talking about all the funds you have, all the accounts you have, and talk to you in regards to where they're at, how much we should earmark yearly, and whatever difference we have, understanding what our liabilities are, and understanding what our accrual base is, we should be carrying it out for the next fiscal 5 years. And then having that money, we know that we have a healthy budget, and we can move that money to different accounts, and we're a little healthier, aren't we?
So when you're talking about fiscal policy in the sense that you're regarding to, so a large majority of the funds you have are going to be debt structure funds and special revenue funds. So you
Got
don't set special policies for those individual items because they're earmarked for projects as is.
Correct.
where you would-
Isaac, what I'm trying to say is that I understand also that there are some accrual, and there's some that are gonna be carried over because liabilities are gonna have extended. What I'm trying to say is that, at the end of the day, what I'm trying to say is that, Mr. Mayor, us as a city council, we should be dealing with our staff and in regards to where our budget is at, and actually setting a policy as per accounts. And I know that there are some accounts where we can't touch, those are actually set. But we'll know what our liability is, and we set that money aside. Isn't it true?
That's correct. If you generate policies as far as reserves, when your internal services
Yeah.
and things of that
and-
nature, you can set aside knowing that you're in the future will have a healthy fund balance within those accounts.
And at
so
the
that you
same
can move
time,
forward
we could know that if tomorrow morning we want to build that fire department or that civic center, we can actually set aside, knowing that our retirement and our budget is sound, we could set aside and say that in the next 5 years, we can actually have that building built because we already set it aside for the last 5 years.
So yeah, if you have a healthy fiscal reserve and you have it, for example, in the ambulance fund, and something does occur, say we have a pension issue where we're hitting a deficit, the market has dropped, they're not getting the returns, we now have to pay in more, a healthy reserve inside your other funds that are not restricted will allow you to pull those dollars in and pay those obligations.
But if we don't, we also have those budgeted aside for those accounts.
Correct. So in the budget process, you're accounting for your current expenditures and things of that nature.
Exactly.
So what
Okay.
we don't want is these funds building up without us knowing about it.
Well-
And then all of a sudden having a project come up and say,
We don't have
hey,
money.
but you got all this money, you know, this fund that we didn't even know about. That's a surprise. It's a good surprise, but it's not a surprise that we should get. We should be able to know what's excess in these reserve accounts. We should have that policy where we're gonna move things out. And you know, the city has never done a capital improvement plan, which the city's working on now, and I think
I-
we ought to fund a capital
I-
improvement budget as well.
I'd like to take
to
it a
that
step
end.
further, Mr. Mayor, and I'd like to say that in actuality, what we're doing is we're gonna actually give him a strong foundation, because then he knows where we're thinking, and his plan, and his vision, and our vision are together, and we know that we're pushing the city at the right direction, and his accounting is solid.
So good
Because
fiscal,
that's what- that-
good
that-
fiscal
that's-
policy, all it is stabilizing your organization. That's
And
really what it is.
And that's what we should be
Yeah.
doing.
I think it's important to tie that in with the budget talks this year,
Yeah.
definitely.
'Cause I know the two of the enterprise funds, the arts and Pioneer Village, they're set, so they're intended for that organization to be self-sustaining. So if
That's
we're
correct.
gonna set a policy of wiping their funds out, then we gotta also realize that they're gonna have to be supported through the general fund or some other fund too,
No,
for their operations.
we're not talking about wiping their funds, we're talking about in regards to the whole total budget.
Right, no, I agree, I'm just saying, I'm not talking to you, I'm just
Mhm.
talking in general, that we also, it's nice to have extra money, but we gotta be sensible on how much we take. We can't leave those funds where they're not doing what they're intended to do.
So, can I say? If I'm understanding this budget, and I apologize that we're going way off the rail here.
That's fine, that's fine.
What I think, and listening and looking at this last
Yeah.
month, I think that it's very important that we talk and have dialogue to a point of knowing our liabilities and knowing how much we have coming in, and setting a healthy, reserve for the actual accounts that need the reserves. And the money we have balanced, we should understand and earmark it to what we believe for the future economic growth of our community is. I mean, that's
agree.
that's what I'm thinking. Anyway.
I think it's
sorry.
important to keep having this discussion and definitely do a budget workshop and to take the, understand and set policy for what we wanna do with these reserve accounts without wiping accounts out, necessarily depriving groups, but being all, having that information, because transparency is what I think we're about, being able to go back to the citizens. I know stability is important from a financial position, but if we don't know what we have, there's no such thing as stability. It's just a concept. We need to know what we have first. We need to know where we stand, and we need to know where we're going with those sound policies. So I think that's important to keep in mind as well.
Okay.
All right.
Any more questions?
Sorry
Right.
for the
Thank you.
sidetrack.
Oh, it's okay. So we're over on page 7, we're looking at the revenues. And as far as the total column goes, you can see that the charges for services increased a couple $1 million. And there are a couple reasons for that. In the governmental activities, they went from 1.1 million to 1.5. Most of that increase has to do with an increase in impact fees from the prior year. And then, of course, in the business type activities, you had the ambulance fund increase, as we mentioned previously, due to the 2 IGT payments received during the year. Now, if you look down a couple line items, capital grants and contributions, as you recall, in 2017, there was a grant that you received for $4 million for the police station, so that's why that number is significantly less this year. If we look overall at total revenues for the city as a whole, 25.8 million last year, the 17 year, 25.4 in the 2018 year. So a very small decrease overall, 395,000 in total revenues compared to 2017.
What's miscellaneous?
What is in
It
miscellaneous?
went down, went from 1.3 to about 962 this year, or last year.
They can be reimbursements and things of that nature. One of the large reimbursements that we got, I think it was in last fiscal, was for the fire truck. It was about 400 and something thousand, so that was a large impact on that number. but it's different items that come in.
That's just a big category. It's over like $1 million.
Yeah, I could provide you with the detail of exactly what's in there. I don't have it obviously at my hands right now, but
Okay.
that's something we could get for you. As far as the expenses go, you can see, looking down at the total for the city, just under $20 million in the 17 year for 1822.1. So it went up a couple $1 million from the prior year. And there are a couple reasons for that. The general government, under the governmental activities, you'll note that that went up about $700,000. That has to do with the letter that you received from the California Department of Finance towards the latter part of the year, saying that you owed some additional monies related to the
So that's the
successor
lawsuit.
agency.
That's
Yeah.
the decision in the
Right,
lawsuit.
right. Mhm. Under public safety, although there was no large variances in any one category, there was a increase in pretty much down the line as far as the police and fire increases, about $400,000 attributable to the police department, fire about $250,000. Of course, your debt service.
Is that wages? The
It's
raises?
everything. It's salaries, it's expenditures, capital, it's equipment, it's everything.
Benefits,
Okay.
it's.
Yeah.
It's mostly
It's
public
down the line.
safety.
I mean, obviously, a large factor of our safety expenditures in all of our departments is going to be labor. So,
Okay, so that's the majority.
Yeah.
Did that reflect the raise from the last MOU?
Yeah.
The
well, this one, I
13%
think they
increase?
took effect, if I'm correct, in this fiscal. It was
Is it
this fiscal.
17?
Yeah, for the
17, 18.
negotiations were within this year, so they took effect into the current year that we're in now.
Okay.
Debt services naturally went up because you had additional outstanding debt. So overall, total expenses, again, they went up about $2 million from the prior year. If we look at your net position or your equity at the end of the year, in total went from 53.4 million down to 52.1. So there was a decrease in your overall equity of about $1.3 million for the city from the prior year. I want to jump over to page 12. Page 10 and 11, it's more detail for the 18 year for the numbers we just looked at. So if you're interested in looking at more of the detail, that's right here on pages 10 and 11. Beginning on page 12 is the governmental funds. And as I mentioned previously, everything we've looked at so far has been on the full accrual method of accounting. The Governmental Accounting Standards Board requires that you also provide statements that look at it from a different perspective, what's called the modified accrual basis. And their reasoning is that decision makers want to know what assets are available as of June 30th, 28 that are going to be available to pay outstanding liabilities over the next 12 months. So over on page 12, these statements are on the modified accrual basis. You'll notice one big omission on these statements. You won't see anything long-term. You won't see any capital assets. You won't see any long-term debt on these statements. This is all pretty much just short-term assets and liabilities. There are 5 what are called major funds. Those are the largest funds: the general fund, the streets, and police station construction. And that's based on certain financial criteria as to what funds are considered major funds. Everything else is in the other governmental funds column, 2 columns from the far right. And those are detailed in the back of the report. But as I said, you have 5 major funds and then several non-major funds, which are included in this statement. So if we look at the general fund, as of June 30th of 18, you had 4.4 million in assets, 1.6 million in liabilities. So overall, your fund balance for the general fund was about $2.8 million. So you can see overall for your governmental funds, you had 21,179,000 in fund balance as of June 30th of 18. Now, just so you have a point of reference for how are we getting from these numbers to the full accrual numbers, if we take the total governmental fund column, okay, and we add in all the long-term assets and the long-term liabilities, those numbers are going to agree to the numbers that we looked at in the management discussion and analysis. In fact, the fund balance number, that $20,179,000 that you see there on page 12, 2 lines up from the bottom, if you go over to the following page, page 13, you can see that number again. What this page does on line 13, it reconciles the two methods of accounting from the modified accrual to the full accrual. So you'll see in this statement, you started off with 21.1, you're adding in the capital assets, you're adding in all the liabilities that are not included on the fund statements, to end up with a net position of 47.4, which is what we were looking at the numbers that we looked at in the management discussion and analysis, those comparison schedules. So that's how the two statements kind of play off each other. All right. Now over on page 14, again, we're on the modified accrual basis. A couple of the differences between the modified accrual basis and the full accrual basis on these statements is, you'll notice that the debt service payments under expenditures, you have principal payments of $284,000. Under the full accrual method, when you incur the liability, it's recorded as a liability, and then when you make payments on that liability, it reduces the liability on the balance sheet. It doesn't hit the income statement like it does under this method of accounting. Likewise, when you do issue debt, under the full accrual method, you record that as a liability on your books. Under this method, since you're looking at the near term, it will show up as revenue. Under other financing sources, you can see that your proceeds from general obligation bonds of $4 million are shown on your income statement, whereas it wouldn't on the other method of accounting. I know it's kind of getting into the weeds a little bit, but just to kind of let you understand exactly what these statements are trying to tell you.
What are these statements telling us? I mean, you've been doing these audits for years. How are the statements looking comparatively? Is the city's financial position improving? Is the city getting healthier financially?
Well, I think the thing that what I like to do in making that determination is look at the financial statements under the full accrual method like we did in the statement of net position.
So this is something you have to do as an accounting exercise?
Yeah, this is required by the reporting standards to present the financial statements two different ways from two different perspectives.
Because it's partial. It's not the whole picture.
Yeah, this is just used as a tool to see what is coming in over the next year and what expenses do we have over the next year. Okay. It really doesn't have any long-term ramifications at all in these statements.
It's more about current expenses,
right,
current assets,
current income, current assets, everything here is current. What's going to be happening over the next 12 months? What happened over the last 12 months? What's going to be happening? Do we have enough assets?
It's not really that timely, so it doesn't really tell us a whole lot.
So, Mr. Mayor, I think just from what I'm hearing, so in actuality, I mean, I was just wanting to know more where our structured budget was. I think if I'm misunderstanding this, but I understand that, well, he's not here actually to tell us if our budget is healthy or not. It's actually making sure that he's accounted for the budget that Isaac's presented to us, and it looks sound, and it's actually balanced out, and it's good, and it's met it's met all the requirements for the state. Now, if we wanted to actually fine tune and look at a budget and have him come and audit our budget into regards to are we standing healthy, and that's a totally different audit.
Yeah, that's true, but in looking at the financial statements, you can kind of tell where there's some things to be aware of that you need to focus on. And one of those things, in my opinion, is that big $11 million deficit in the unrestricted balance. I'd like to see that number go down, yeah.
So
Yeah.
that's a kind of a warning
Yeah,
sign.
it is a little bit.
And why do we have that $11 million deficit in our unrestricted balance?
We now put pensions and OPEB on there as a liability. That's a huge change.
Yeah.
And that's something we should be talking about in our budget in regards to earmarking. You guys call it, well, we're calling it, trust.
Yeah, there's different methodologies of addressing it, the 120
And
or
that
115
would go
trust.
back, and that would go back into our budgetary, workshop, where we could actually state that these are our liabilities, long-term or accrued. This is what we're having as, at the end of the year, net profit, as you call it. This is what we're earmarking for in the next 5 years. We can actually entertain discussion of either a civic center, or a community center, or whatever, have that budgeted out, earmarked, and in 5 years, we can also resolve that issue, and we can resolve our economic, financial structure.
Yeah.
Sure.
Yeah.
I think
So-
it's important to have this discussion with the professional, with the CPA who's actually doing the audit, going in the weeds for the city. I think it's important to ask those questions. Other cities don't ask those questions, and I think we need to, because that's important, that we can, focus on that 11 million, that's something that a professional auditor who does this all the time for other cities picks up. What's one factor that looks pretty good that you saw, that's the city selling?
Well, your enterprise funds are pretty healthy.
Okay.
Yeah,
Price
so,
funds.
One of the factors I want to point out too, as far as the general fund and intelligence, you're now hit your reserve policy of 20%. So your fund reserve itself is at a 20% marker, and you haven't been there for a long time.
We are there.
We are there now.
And so 15% is just a reserve, and the 5% on top of that is what?
It's an emergency reserve. So by council action, you could utilize those monies and what they see as an emergency factor.
And that's a 3/5 vote or a 4/5 vote?
I want to say it's 3/5, but I'd have to look into the policy again to really identify that. But I would assume it's a 3/5.
Okay. And that's a restricted account that we have here?
It's in the general fund. It's not necessarily a restricted account. It's just part of our fiscal policy as a reserve. So it's unrestricted in the nature of what kind of funds are in there, but it's, as our fiscal policy defines, it is reserved for that sense.
Mhm. So I think it's valuable to know what those totals are in each budget, like we did in January for the police station. When he showed all the potential funding sources for that police station, I think that's what took us some of us aback, having that increased amount in that ambulance fund, not knowing that before. And I think that's why we're doing what we're doing today. We've never done this, had an audit report like this. So I think it's very valuable to know where we are, to come back to that transparency with the citizens who are always asking, where's our money going? What's it being spent on? We can't tell them if we don't know.
I think
We gotta know.
I think
And
we
this is a
gotta.
very valuable exercise.
I
for
think we
them.
gotta take it a step further. I think we gotta have a workshop to do our budget. I think a healthy financial plan would actually be a strong financial plan would be a strong backing to our finance director, because our finance director would understand that we understand the plan, and we understand our growth and our needs, and we budget them, and we earmark them, and we set a plan for the next 4 years with that money that is coming.
So one of the things you're going to see within the budget process this year is actually doing a forecast for the next 5 years. So we can actually look at, was it 10 years? The projected revenues and expenditures and how the impacts are going to be for the pension obligations. So you're going to start seeing those numbers actually pull away from each other, the revenues and expenditures over a couple of years, because of the impacts of the changes in the pension obligations. So
Because
we're
we
going to
know
have
that's
that
coming.
conversation.
Yeah, we know it's coming.
So we have multiple factors that we want to look at this year.
Something
We
gotta
want to forecast out what our revenues and expenditures are going to be. We want to look at our current fiscal policies and what we believe would be good fiscal policies to create reserves and stability within the future years, to make sure that we can sustain those payments. Such as, should we create a trust, a 115 trust? Should we pay that money down and just make some kind of payment, set it aside? There's different things and tools that we could use, but we need to, as a whole, as a body, have that conversation, because it does impact your current year policies, but it's also going to impact your budget. So having your budget conversation, you create those policies, and you're actually talking about the future, not just that year. So that's good fiscal policy for you to do.
You're right, and we also have to make sure that our department heads are actually expressing what they really needs are. So we can have them also factored in to the 5 to 10 year plan.
So I think our next budget meeting should be a workshop structured, just like we're talking about now. Look at the enterprise funds, look at the reserve, and formulate those policies on how those funds should be transferred out, if any, and which should be kept in. I think that's a step forward to managing the city's financial resources, which is our job after all. All right.
Okay, over on page 16 is a detail of the proprietary funds or the enterprise funds. So if you want to, again, we've gone over these numbers when we looked at the management discussion and analysis. This statement on page 16 just gives you a little bit more detail of exactly what was in those numbers. The assets and liabilities net position for those are on page 16. The revenues and expenses are over on page 17. Over on page 19, we're getting into the fiduciary funds. First column being the successor agency. You can see what the assets, liabilities, and net positions were for that as of June 30th of 18. There's actually a deficit of almost $4 million in that. Of course, that will go down as you get are getting your property tax monies over the coming years, paying down that debt, and then that net position will come back to zero eventually, and the successor agency will be closed down, but that's going to take a while. On page 20 are the additions and deductions to the fiduciary funds. You can see you brought in $672,000 and paid out $388,000. So you had a positive change, $283,000 in the fiduciary funds. Now, the next section of the financial statements, which begins on page 21 and goes through page 54, are the footnotes. So the footnotes provide you with additional information on the numbers that we've already looked at. Page 21 through page 27 goes over all of your accounting policies. So if you're a little bit fuzzy about what I was discussing regarding the different methods of accounting, that's all in here. You can go ahead and read through that and get a more firm understanding of exactly what I was talking about. Over on page 29 is a breakdown of what you had your cash balances invested in as of June 30th of 2018. You can see you had deposits with financial institutions of $5.5 million, investments of 22.8. Now, these figures include the fiduciary funds. There is a detail of that 22.8 million over on page 30 on the following page down at the bottom. And you can see that those funds are primarily invested with LAIF, 22.3 out of the 22.8 million, or with the local agency investment fund. Over on page 33, a breakdown of your receivables as of June 30th of 2018. For the governmental funds, you had almost $1.2 million. You had receivables from sales tax, property taxes with Fresno County. You had some grant monies that were outstanding at the end of the year. As far as the enterprise funds go, the ambulance fund, a little over $2 million in receivables at the end of the year. There was an allowance of $500,000, so you are expected to net about $1.5 million from those outstanding receivables in the coming year, in the 18-19 year. And then the fiduciary fund, $725,000 in receivables. Now, due from other agencies, that $463,000, those are monies that are due primarily from the city, and those are recorded as a liability on the city side. Page 34 shows your capital assets, your beginning balances, your additions, retirements, and your ending balances, and it's broken down between the governmental activities and the business type activities. So you can see you really don't have a whole lot of assets in your business type activities, your enterprise funds. Most of it is in the governmental activities. And you can see you started the year with 49.6 in capital assets, ended the year with 50.5. So you had an increase in your your assets after depreciation of about $936,000. And over on page 35, middle of the page, this is your interfund activity. It shows you which funds owed other funds at the end of the year in the interfund payables and receivables. Those totaled $347,000. And down below at the bottom of the page, there's a table of what your transfers were during the year, totaling $3,636,000. You can see what funds those went into and what funds those came out of. Over on page 36.
So back to that last one, the Proprietary's ambulance fund, the 1.1 million.
Yes.
Got it.
Yeah, those went from the ambulance fund into the general fund. Okay. Any other questions on 35? No? Okay, page 36, detail of your long-term liabilities. As I mentioned previously a couple times, you issued some general obligation bonds for $4 million during the year. You also had some capital leases that were new in the 17-18 year for some police vehicles, $585,000. You started the year with $6.6 million in long-term liabilities. You had increases of 4.7, and you paid down debt of about $711,000. So your ending balance, $10.6 million in outstanding liabilities as of June 30th of 18. Down below is some additional information regarding those debts. From pages 37 through 42, there's a detail on each one of these debts, exactly what they are, what they were used for, what the collateral is, what the debt service requirements are. So if you're interested in any particular debt, there's more information that's provided on the following pages. Now, if we move over to page 49, we're getting into the pension liability. And I know we've discussed that quite a bit already, but just one thing I wanted to make you aware of, that liability that's on the books, keep in mind that that is just an estimate. It's based on a discount rate of 7.15%. So we're at the table down on the at the bottom of page 42.
That's huge. That's pension, right?
I'm sorry, what was the discount rate?
It was 7.15% is what was used to determine the liability as of June 30th of 18. So as the liability goes down, or as the interest rate goes down, that means you're not receiving as much money on your investments. The liability is going to go up. There's an inverse relationship between the discount rate and what the outstanding liability is. So if it goes down 1%, the interest rate goes down 1%, your pension liabilities are going to go up significantly. Now in total, using a discount rate of 7.15%, for miscellaneous and safety in total, it's just over $15 million, the outstanding liability. If the discount rate were to decrease 1%, that liability would go up to $17.5 million.
That's a bankruptcy situation.
And likewise, if for some reason you have an increase in the discount rate.
Do you guys hear that? 1% would put us over the edge. I mean,
Yeah,
this is a
that's an
serious
additional
issue.
$2.5 million in liability just by a 1% change.
We can't put all the money in there, but we need to at least address it, and it's not gonna just be the money from the tax sharing agreement. We've gotta have a concerted approach. Exactly, we gotta put a portion away, and that 115 trust he's talking about is a good potential. We'll have this discussion, but I think this is really important that Phil's letting us know these kind of scary numbers, realities about the pension. That's one of those things on the horizon
Well,
we got to take account of. for the
Mr.
city.
Mayor, the cup's half full and half empty. A healthy, structured budget with earmarked money, knowing that we're a municipal government and we receive money come in and go out, will take care of this issue. We understand, and it was projected that interest rate is going to go down, or is going to go.
Discount
Yeah.
rate go down.
Yeah, so we are gonna lose that. But if we have a healthy, structured plan, we'll be okay. So I think that it's more of a reason why we need to have these workshops, more of a reason why we need, I mean, the answer to everything is the fact that we need to have housing, we need to have businesses. That's what's gonna make our budget is 13 million. We should be aspiring to have 20 million within 4 years.
Which would create impacts on our services that we need to pay for. So you can't just say that there is a magic bullet, Mr. Councilman. I appreciate the political speech, but we all know we need more housing.
I'll go
We
with
all
the
know- we
grandstanding
need
of,
more-
I'll
we
go
need
with the
more
grandstanding
businesses.
of you stating that we are in a crisis, when in fact, if we build businesses and we build homes, it is the actual answer to us.
Yeah, you're putting
There's
words
no-
in my mouth. I never said we're in a crisis. I was saying this is something, Mr. Councilman, that we need to pay attention to. You're the one who said it was a crisis.
Well, the
so-
last city council meeting, you said that we needed to. Well,
Yeah,
I just answer your questions. I'm just a
We're not
I'm just a
making-
realist.
We're not making
I'm just a
political
realist.
discussions here. You are.
I'm just
So
a realist.
We're just looking at the budget audit today. So we could,
Okay.
let's save our political
There you
speeches
go.
for the
Well,
city council meeting.
Well, I don't know.
Great.
Go
I
ahead.
wasn't here in 2012.
That's okay, guys.
So just one marker to kind of go off what these numbers look like and how he's giving these assumptions of how these factor in. This is the conversation we've been having when we started talking about the discount rate and it dropping. So you can see how these numbers impact each other. There is still conversations that the discount rate should be lower than what it's currently going, which is currently stepping down too. So obviously we'll keep an eye on that and keep you informed on what pension's doing. So again, pension's a large factor for our city. It's something we need to keep an eye on. It's something we need to plan for the future. It's something we need to stabilize. So there's no magic tool. Nobody's has that magic item on how you fix things. It's really setting aside money, addressing it for the future, so you're stabilizing for the future and allowing PEPRA to kick in. But PEPRA's not really going to be a factor what they estimate about 20 years. I mean, we're a couple years into that 20-year marker now, but it's something that we just need to keep an eye on and stabilize for the future. And there's different rules and things and policies and objectives that we can do. Some of it's, a lot of it's addressing it during the budget process and understanding what your inflows and outflows for the years, not just for next year, but for the next 10 years, the next 5 years, what are those numbers going to look like, and making some of those assumptions. Obviously, at a factor going out that long, you're making some assumptions, but you can make some factors on how your revenues are growing. What is sales tax doing for the last 5 years? I use those assumptions and obviously use inflation as a number too to compensate for some of that, but you have those discussions. Okay.
Great.
Okay. So if we're optimistic and we say the discount rate's going to increase up to 8.15%, then the liability would only be 12.8 million. So just to let you know, hey, these are just
I'll take that.
estimates. It can go up a couple million, it can go down a couple million, depending on investment returns, how those come in over the next few years.
So the market is a huge factor.
Exactly. Now, let's take a look at that same information for OPEB, which is over on page 52. Now, these liabilities are discounted at 3.56%, so significantly less than for the pension liability. $5,244,000 with a discount rate of 3.56%. If those increase up to 4.56, then the liability is going to go down to 4.5. And if the discount rate goes to 2.56, it's going to go up to just over $6 million.
If these are health benefits, what effect does the market have on that, the health insurance market have on that, the rates in the health insurance market?
You know what? Interesting you should mention that, because over on page 53, there's an additional disclosure that you're required to have in your statements. This one has to do with your healthcare cost trend rates. That $5.2 million, that's based on an anticipated increase of 8% in healthcare costs. So if those go up to 9%, then your liability would jump 6.6 up to 6.6 million. If they decrease by 1 percentage point, it go down to 4.4. So that's what kind of impact the change in healthcare rates would have.
That's a big component of the discount rate.
Yeah. Mm-hmm.
Gotcha.
Let's see, page 55 is the supplementary information. These are the budget to actual statements. You're required to have these for the major funds, so we don't have this report or this page for every single fund that the city has, but we do have them for the major funds. Although there were a couple of funds that really weren't budgeted, the police station construction and the bond. But for the general fund on page 55 and for the LTF funds on page 56, it's got the final budget numbers, the actual, and the variance between the two. If you look down at the far right-hand column, you can see that the fund balance at the end of the year, there was a positive variance of about $300,000 for the general fund over what was projected when the budget was done. And over on page 56 for the LTF fund, there's a positive variance of almost $910,000 in that fund. And then the financial statements conclude with the combining statements. As I told you previously, that column that says other governmental funds is made up of everything else other than these major funds. And those are all detailed in the back of the report, beginning on page 64 and going through page 87. So there are about 24 additional pages of detail for those other governmental funds that if you want to know how each individual fund is doing, you can refer back to that. So that's pretty much the financial statements. Were there any other questions or comments on it?
That's a big report. Thank you for coming out. Sorry that
Oh,
you rescheduled.
my pleasure. No
Can you
problem
imagine
at
if we
all.
tried to do this at the city council meeting?
Yeah.
I mean, gosh,
I think-
we've been here an hour and 20 minutes.
I think you were right. We had other questions and he answered them and we together answered them. You know what I mean?
Yeah, it was nice,
And then
nice to work together like this and talk about, I
Yeah.
think this led us in the
Yeah,
direction of
It's a good meeting.
getting into more detail.
We
Yeah.
I thank you for coming out here. It
Oh,
probably,
sorry.
we probably had a different question in regards to us and you answered some of the questions and you helped us.
Okay,
Thank you.
good.
Mr. Mayor, I'd like to make a motion that we accept the financial report audit.
I'll
for
second
this.
it.
Call the roll, please.
Mayor Pro Tem Franco.
Aye.
Councilmember Avalos.
Aye.
Councilmember Garrett.
Aye.
Councilmember Trujillo.
Aye.
Mayor Robertson.
Aye. All right, with that, we'll
PDF.
move
can
on
change it
to
like page
adjournment. And I don't think we need a motion. We will adjourn at
I know you're gonna
10:20.
set it out as a funding source or something. Yeah.